Audio check. Testing the audio, making sure we're good to go. Welcome everyone. We'll get started here in just a second. Sorry for the little bit of delay. Sound check, someone say something. Robert's looking for a sound check. Okay, give me 1 second. I'm going to adjust something real quick. Okay, we're back. Welcome everyone. My name's Kyle McCauley. I have no idea why my camera, that's what I was just trying to fix. I hope none of you are, what's the word I'm looking for? What's the thing where you have to have everything in a row? I can't, obsessive compulsive. I'm not obsessive compulsive, but I do like things to be neat and orderly, and I have no idea why my screen is wonky. But it is, so sorry about that, but I guess there's nothing I can do about it. I just want to make sure sound is good on Facebook, and then we're going to get started. Someone on Facebook, let me know that we're rolling and you can hear me just fine, please, if you could. Just want to verify that before I take off at full speed. Okay, all right, Facebook is good, thank you. Thank you, Rick, all right. Okay, my name's Kyle McCauley. I'm one of the national presenters here at Einstein Retirement Workshops, and it was a busy day for me, so I didn't have my normal setup time. So for those of you who are just joining in and wondering why my screen is a little crooked, I don't know. I haven't had time to fix it. Apparently my camera's off a touch. So in any case, our tech team is remote. I do have a tech team going, but they handle back-end stuff. So I normally get the camera looking good. Anyway. All right, you're at our most popular presentation, our Social Security filing workshop. This presentation has now been attended by several gosh, I don't even know the number. It's got to be more than 100,000 people by now. So we're glad you're here. We're excited to continue to do this. We've done this workshop now in this live stream format for well over a year, going on 2 years. And that's with the wonderful advent of travel restriction and all of that. So Einstein Retirement Workshops is a national organization. We used to do workshops in your neck of the woods, you know, community centers, libraries, colleges, that sort of thing. But now today with everything going on and the initial travel restrictions and all that good stuff, we now do this in this live stream format. Let me give us a little bit of an agenda for our time together. If I can figure out what's wrong with my clicker. Our agenda for today, we are going to spend just over an hour on the topic of Social Security, and then at the end of that hour time together, we will go right into two things. Number one, we'll talk about how you can get access to your Social Security filing workbook. I know that many of you are here and joined in, and we're hoping, looking forward to getting a copy of our Social Security filing workbook, and so we will discuss and address how you can receive that. It is a physical workbook that we mail you. We put it in the mail. So we'll talk about how you can request that. Secondly, we will also talk about questions, your questions. So we'll have a Q&A portion of our time together right at the end of the presentation as well. For those of you who noticed, I was able to tap on a couple of comments and I can highlight them, put them on the screen. So you'll just type them into the chat when we get to the Q&A portion. I'll highlight them and then we'll answer those questions. Again, my name is Kyle McCauley. I'm one of the national presenters here at Einstein Retirement Workshops. I'm also the managing partner of City Center Financial, and I really just highlight my background to you so that you have an understanding of the perspective that I bring to the table when I do this presentation. In addition to being the managing partner, I'm also a chartered retirement planning counselor, an accredited portfolio management advisor, and a national Social Security advisor certified professional. That's all important to you because we're not affiliated with, nor are we associated with, the Social Security Administration. Our job is not to sign you up for Social Security benefits. Our job here today is for me to lend my expertise and the expertise of our firm in working with hundreds of folks just like yourself. I guess I should now say thousands of folks just like yourself in making a high quality Social Security filing decision. And we're going to lend you some advice based on our experience and expertise in this arena. We're allowed to do that because of our registered investment advisory firm, City Center Advisors. Why is Social Security such a hot topic? Why are all of you here? Well, Social Security is a hot topic for a pretty basic reason. There's a lot of you who qualify for benefits. About 10,000 baby boomers every day are turning 65 for another 13 years. And that works out to about 3.64 million new folks who are qualifying for programs like Medicare and Social Security every year. Common thought behind this would be, hey, wait a second, that's a lot of people who are no longer working and paying taxes into the system. This is now a lot of people who are retiring and pulling dollars out of the system. Am I going to get my money out of this or what? And so solvency obviously becomes a big concern, and we'll spend some time on that. I do want to address that for you. Also, Social Security, 65% of middle-income Americans derive more than 50% of their retirement income from their Social Security benefits. Now, that of course is true for those who maybe haven't done a great job of saving other types of retirement income, but definitely it's going to be true it's also going to be true for those who have done a good job of saving other forms of retirement income in many cases. The simple reason for that is, number one, the benefits are still here. Number two, not only are the benefits here, but in many cases they can be quite good. It is not uncommon for us to see a married couple with $40, $50, $60, sometimes even $70,000 or more in combined benefits. Also, pensions have been eliminated, frozen. We've unfortunately seen pensions where the benefits have been reduced even after folks have filed for them. And so the negative impact on pensions has elevated and enhanced the need for Social Security. Also, 46% of Americans today pass away with less than $10,000 to their name. This statistic is not here to frighten you. What it is here for is to highlight one of the very important attributes or features of Social Security. If you were to ask yourself, do I insure important financial things in my life? I would guess that most of you, if not all of you, would say, yeah, of course I do. How about your house? Right. Your car? Yeah. What about your health? Obviously. Do you insure your retirement? Well, the answer to that is probably yes. If you frame in your retirement correctly, the appropriate filter or viewpoint to put on Social Security is as retirement income insurance, or there you could say longevity insurance. Why longevity insurance? Well, people are living a lot longer than they ever expected to. If you're a married couple age 65, gentlemen, you have a 50% chance of living to 92. Ladies, your life expectancy, all the way out to 97. So not only are you still going to receive Social Security benefits no matter how long you live, but even if you're living up into these 90 plus age ranges, which at least 50% of you probably will, then even if you have nothing, you have no dollars, you're this person unfortunately here with less than $10,000 to your name, even if you're that person, you still have Social Security benefits coming to you. So, pretty important to remember that the possibility of living to a very old age certainly exists. My granddaddy is a great example of this. His wife, my granny's still living. She's 92. We'll see if she makes it to 97. He did make it to 92 himself. He passed away just last year, not COVID, just old age. And unfortunately, not unfortunately, fortunately, he was still able to live a good long life, and he actually lived pretty well until the last several years. But honestly, if you had asked him, say at age 80 or 75 even, he had 4 heart attacks and 3 bypass surgeries before the age of 75. If you had asked him if he thought he was going to make it to 90, he would have said, no way. But medical technology, frankly, my granny kicking him in the rear a little bit, he made it all the way to 92. So, you know, it can happen. Even for those with health problems and all of that, the reasons that we normally think we won't make it that long, sometimes you still do. I don't know if you can live quite as long as this gal, Ms. Kane Tanaka. She's currently the oldest living person. We'll see if she makes it to 119. Her birthday's in January, so we're getting close. She's from Japan. Interestingly, of the last 5 oldest living people, 4 of them were from Japan. So, you know, if you're thinking about relocating, you might want to consider Japan. Okay, let's talk about some basics about how your benefits work. Right after that, we'll go into strategies for those of you who are married, options for those of you who are divorced. We'll go to options for those of you who are widowed. And if you fall asleep somewhere in the middle, or you say, hey, wait, I'm single, I'm not on that list, well, just hang on a second. Because let me tell you, especially if you're single, but even everybody else really, taxes is the big one. Okay, you do want to make sure that you wake up in time for taxes, because I can tell you, again, our organization has now helped thousands of folks make high quality Social Security filing decisions. And if there is one single item that will take 2 strategies that, you know, that kind of, this one seems okay, it seems okay, you know, maybe you have to live a little longer for this one or that one. Okay, fine. But if there's one that's going to say, this one stinks, we got to file this way, it's going to be the issue of taxes. So I do want to make sure we have enough time to cover that. Let's talk about some basics about how your benefits work, how they're calculated. In order to qualify for a Social Security benefit, you need to have 40 credits. 40 credits works out to 10 years worth of work, because you can earn up to 40 credits per year, 4 credits per year, and 4 credits per year. Substantial earnings in a calendar quarter, 1,470, goes into 40 credits, making up 10 years of work. Now, if you're not sure if you have the 40 credits, you can go to ssa.gov, and at ssa.gov, you can log into your Social Security profile, and it will show you with green bars and a check mark at the end whether or not you've qualified for a benefit. But you do actually have to have a profile and sign up. Not sign up for benefits, excuse me. Sign up for a profile. I have a profile, okay? And I'm not old enough to file for benefits. Okay, once you have qualified for a benefit, if you have that green check at the end of your green bars there, the way your benefit is calculated is by using the highest 35 years of indexed earnings. Not the most recent 35 years. Not the most consecutive 35 years. It's okay if you had 5 years, took 5 years off, worked another 20, took a couple years off, worked another 10, that's still 35, no problem, okay? Don't have to be in order, they don't have to be consecutive, but it's the highest 35 years no matter when those years occurred. But it's not those years like in terms of the actual dollars that you earned. So if you were to look at page 3 of your Social Security statement, you would see a table with all the years of earnings that you've had where you paid taxes into the Social Security system. The way Social Security calculates your benefit, they take years in times gone by and they increase those dollars or index them for inflation, and then they use that index number to calculate your benefit. An example of this, okay, and just to be clear, these indexing tables, if you're curious how that works, are in the Social Security filing workbook, okay? So we're going to talk about how you can get that workbook again at the end of the presentation. But in that workbook, there are indexing tables. And so what you could do is, let's say you earned $20,000 in the year 1980. $20,000, what you do is you take that to your indexing table, you'd put it on the 1980 line, and you would see that you need to multiply that number by 4 and change. So when Social Security calculates your benefit, $20,000 earned in 1980 is worth more than $80,000 in your benefit calculation. Now, what happens in a scenario where you don't have all 35 years? Let's say you only have 25 years. Well, in that case, what will happen is Social Security will take the 25 years that you have, they'll index those for inflation, calculate your benefit, but as part of that benefit calculation, they will add in 10 zeros in your 35 years. So any additional work that you're doing today, if you don't have all 35 years, will be replacing a zero and should do a nice job in terms of increasing your benefit in the future. There are two primary provisions that can reduce your Social Security benefit, and they apply whenever you have what is called a non-covered pension. If you have a non-covered pension, that's a pension that you earned while you were not paying taxes into the Social Security system. If you don't pay taxes in the Social Security system when you're earning that pension is non-covered, and when you receive those pension dollars, that will cause any Social Security that you're simultaneously entitled to be reduced if you don't have enough years of substantial earnings with Social Security. I don't have all that memorized. It's a fairly complex calculation, but it is in your workbook, okay? So if this applies to you and you're getting the workbook, those calculations are in there. Now, if you have a non-covered pension and you don't have Social Security of your own that you're entitled to, but you have an ex-spousal or a spousal benefit that you're entitled to, 2/3 of the pension will count against the Social Security from your spouse, and if that number goes negative, then you get nothing, okay? You get nothing from Social Security. The WEP, the windfall elimination provision, is the one that applies to your own Social Security. That cannot reduce Social Security to zero. The GPO, or government pension offset, applies to the spousal benefit, and that could reduce it to zero. I don't know if you know this, but you probably do. You've paid a lot of money into the Social Security system. 6.2% of your pay has been going into this system over the last 10, 20, 30, 40, however many years you've been working. Your employer did the other half of that for a total of 12.4% of your pay. Unless you're self-employed, then you got to pay both. But I think if you could imagine an account somewhere with 12.4% of your pay in it, that might be a big pile of money. Maybe a heck of a big pile of money if you apply even a little bit of interest to it. So look, I know I'm probably preaching to the choir because you're here, but these are your dollars. This is an entitlement program in the truest sense. You are absolutely entitled to these dollars. You've paid for them. It's worth doing the planning to maximize what you get out of this system. Unfortunately, the way the system works is that it is not a system where you have your account and your money's going to come to you from that account. The way it works is that it's a pay-as-we-go system, meaning taxes flowing in today are leaving today to pay current recipients. The reason why we're both in the red but fully funded, through 2035 is because at one time we had a surplus with Social Security, and what did the Social Security Trust Fund do? They loaned it to our government via U.S. Treasury bonds, okay? So some people think they raided Social Security. You might have heard stuff like that. Not technically. That's maybe a little hyperbole going on there. We don't do that, though, in politics, do we? All right, so anyway, they didn't raid the Social Security Trust Fund. What they did was they had the Social Security Trust Fund purchase U.S. Treasury bonds, effectively loaning money to the U.S. government. So those bonds are actively being sold today because they need the cash flow. We're fully funded through 2035, and in 2036, we're only funded roughly 75 cents on the dollar thereafter. So here's what will not happen. This system will need to get fixed. It's been fixed many times before, so just bear with me. None of you need to worry about your benefits getting cut, okay? So although we're only funded 75 cents on the dollar, it's not as if they're going to slash your benefits by 25%. Just, you can pretty much write that one off. However, what they will do is they will do to your children and grandchildren what they did to you. When you first started paying taxes into Social Security, likely, the system was set up that you didn't pay taxes on Social Security. Now you do. It was also set up, or most of you will, maybe not all, but most of you. And it was also set up that you could retire with your full retirement age at 65. Now the oldest of you have a full retirement age of 66. There's a bunch of you that have a full retirement age of 66 and some number of months. And then the youngest of you have a full retirement age of 67. So they'll do that to your kids and grandkids. They'll probably push it up to as high as 70. Very likely, this is extremely likely, they will take away the age 62 filing, and your children and grandchildren will have to wait till 65. Why am I so confident that it's not going to affect you? Well, our government is not too big a fan of losing votes, and the retirement age generation, whichever one it is, tends to vote consistently, and so they're going to be very cognizant of that, A. And B, current federal law says that once you reach the age of 55, they cannot change your Social Security benefits. So the solutions, very unlikely to affect you. Most likely kids and grandkids. Once you hit 55, you can pretty well plan on the benefits that you're expecting being available to you. Okay, I do know that many of you do have that full retirement age of 66 and some number of months, and that there are some of you with a full retirement age of 67. However, just for ease of explanation, what we're going to assume is that everyone has a full retirement age of 66. When you retire, when you file for Social Security, all of your benefits are based on what is known as your primary insurance amount, or PIA. That primary insurance amount is the amount that is estimated for you on the very front page of your Social Security statement, that big bold number in the upper right corner. That is your estimated primary insurance amount. If you file for your benefits at your full retirement age, you are eligible to receive 100% of your primary insurance amount. So if that number in the upper right corner said $2,000, you would receive $2,000 if you filed at full retirement age. You are allowed to file early. You can file as early as the age of 62. If you file at 62, you will receive a 25% reduction. So that $2,000 benefit will be turned into $1,500. If you would like to delay past full retirement age, you can do so and be rewarded. You can be rewarded at a rate of 8% per year in delayed retirement credits. You can turn that $2,000 benefit into $2,640 by age 70. If you delay past full retirement age, they will absolutely let you, but there's nothing in it for you, okay? There's no benefits that will be paid to you if you delay past full retirement age. Or excuse me, age 70, sorry. Not full retirement age, age 70, okay. All right, there are three distinct benefits that you can file for. The first one is a retired worker's benefit. This is the benefit that you are entitled to based upon your own work history. The spousal benefit is the benefit that you're entitled to based upon a spouse or an ex-spouse's work history. And then widow or survivor benefits are benefits that you're entitled to based upon a deceased spouse's work history or a deceased ex-spouse's work history. The last time Social Security law was changed was October of 2015. Basically, what they did was they took away all of the fun stuff. So if you've ever heard of file and suspend, get a lump sum check, any of that kind of stuff, well, all of that's gone, okay? So the only exception to that is for anyone born before January 2nd of 1954 who has not yet filed a Social Security benefit, who has access to a spousal or ex-spousal benefit. You can do what is a restricted application, file for those spousal or ex-spousal benefits, and then switch to your own benefit later on at age 70 without any effect to that maximized personal benefit. Okay? But you have to be born before January 2nd of 1954 and not have filed for any benefits yet. If you were born in that group or after that group, there's really just a couple of things to keep in mind from a Social Security filing strategy perspective. The first is, if you file for benefits, you are allowed at any time for any reason to suspend those benefits, telling Social Security, stop paying me. Why would you ever do that? Well, let's say you filed for benefits and then realized, I kind of wish I hadn't done that. I'd like to earn some of those delayed retirement credits, or I'd like to do some Roth conversion tax planning and I need to delay a little bit. Okay, any of that kind of thing, or you were laid off from a job and you're reemployed and you don't need the Social Security yet and you'd like to get the increases. Any of those reasons, doesn't matter the reason. You could suspend for no reason at all, okay? But if you're younger than 70 and you suspend benefits, from the point at which you suspend until you file in the future, as late as age 70, you can earn any increases that you're entitled to during that time period. If you suspend within the first 365 days from when you filed, so within the first year, you are allowed to, one time only, rescind your application. Rescinding your application resets your benefit as though you never filed. Don't get too excited about this because there is a catch. In order to reset your benefit as though you never filed, you must pay back any dollars you've received up until that point. Okay? All right. Let's talk about spousal benefits. In order to qualify for a spousal benefit, you need to have been married for at least 1 year. In addition to that, the primary worker, the person that you're filing off of their benefits, has to have filed their benefits in order for you to file off of them. Also, you cannot get your own plus the spousal, okay? It's the higher of the two. So if you have a benefit of $1,200, your spouse's benefit is $2,000, 50% of their benefit is what you're looking at. So $2,000 goes to $1,000, $1,200 is more than the $1,000, so no spousal for me, okay? I just get my $1,200. Now, it is 50% of your spouse's primary insurance amount, not what they are receiving. So if John has a primary insurance amount of $2,000, Jane is eligible for half of that, $1,000, at her full retirement age. However, if John waits till full retirement age, he's getting $2,000. If Jane files early at 62, she's not getting $1,000, and she's also not getting $750, which is what she would get on her own. She gets only $700 because it's a spousal. So spousal benefits reduce on a faster schedule when filing early than your own benefit. Also, if John delays till 70, he's getting $2,640. But if Jane delays till 70, she's still only getting $1,000. No delayed retirement credits on spousal benefits. For my married couples, when one of you passes away, only one benefit remains, and it's always the higher of the two. So in my example, John and Jane, if Jane passes away, she takes her $1,000 with her. John keeps his $2,000. If John passes away, Jane says goodbye to her $1,000 and she keeps John's $2,000. Only one benefit remains. It's always the higher of the two. The only caveat to this is the 82.5% rule. If John had filed early, he's not getting $2,000, he's getting $1,500. But if he predeceases Jane, she will get a little bump up. That $1,500 is 75%. The 82.5% rule says that the minimum Jane will get is $1,650. Two most common mistakes we see married couples make. Number one, higher wage earner files early and shortchanges a surviving spouse. Remember, when you think about your Social Security benefits and you're framing them into your retirement income strategies, plans, optimizations, think about it as longevity insurance or retirement income insurance. So, the higher wage earner, okay, again, I'm talking right to my married couples right now. The higher wage earner between the two of you has the benefit that will become the survivor benefit. So you think, gosh, I don't know if I want to delay till 70. What if I die at 72? Right. Except, what if you die at 72, but then your spouse lives to 92? That's 20 years of one Social Security check. So there again, if anyone's going to do any kind of delaying to maximize a benefit, it's going to be that higher wage earner. And the reason is you want to try and maximize, in as much as is reasonable and possible, the survivor benefit for whichever one of you outlives the other. Second mistake that we see is that both delay past full retirement age. Again, this comes from our experience in running thousands of analyses and looking at the tax ramifications. I can just tell you it almost never works out for both spouses to delay past 70. Generally speaking, one of you is going to file early to some degree or another, and one of you is going to delay to some degree or another. Very common circumstance for married couples. I just saw one earlier today. One spouse was getting ready, is older and thinking about retirement. It's coming up quick. Very good Social Security benefits. The younger spouse also very good Social Security benefits. And so which one is higher? The older spouse's was just a little bit higher, but not much. And the reality is it could catch up if the younger spouse kept working and had a higher earnings. So, you know, it's kind of a toss-up. Whose is going to be better in the long run? But here's the key. That older spouse hit 70 first. So even though their benefits were virtually equal, the older spouse, it made loads of sense to maximize their benefit to 70 so that that survivor benefit is as high as we can get it. But that younger spouse, we're actually going to plan to file it as early as possible at 62 because it's not as valuable. Okay, so there's an example for you of how this kind of works out. So it just, again, typically speaking, one spouse is going to delay to some degree or another. One spouse will file early to some degree or another. I gave you an extreme example, but it was a good one. All right, considerations for those of you who are divorced. In order to file for a divorced spouse benefit, you need to have been married 10 years in a row to the same person. Okay. Married, 5 years. Divorced, remarried, even to the same person, 7 years. Divorced. 5 plus 7 does not equal 12. One of those two stints has to at least hit 10 years in order for the divorced spouse benefit to apply. I know that none of you came on here for marriage counseling, but you know, if you need a reason to hang on, there you go. You may not be currently married. So if you had a marriage that lasted more than 10 years and you're thinking, gosh, maybe I'd like to file off of that ex-spousal benefit, but you have a new spouse, say goodbye to the ex-spousal benefit. You're just dealing with either your own or the new spousal. Same benefit amounts in terms of extra penalties for filing early or extra reductions for filing early, as well as no increases for delaying, apply to the ex-spousal benefit in the same way that they applied to spousal benefits. The one major difference between ex-spousal benefits and spousal benefits is the independently entitled provision. And that basically says that if you've been divorced for at least 2 years, whether your spouse, your ex-spouse, filed for their benefits or not, it doesn't matter. You can file on your own schedule, so long as that ex is at least 62. If you were born before January 2nd of 1954 and you've not yet filed for a Social Security benefit and you have a marriage that lasted more than 10 years, the restricted application could be particularly advantageous to you, but you're running out of time. All right. One goofy thing about divorced spouse benefits. If you had a marriage that lasted more than 10 years and that spouse is younger than you hit 62, file for your own benefit. A couple of years go by, that ex hits 62 and their spousal's more than yours, you can switch. Okay? And if you can manage to fit another 10-year marriage like that in there, you can switch again. As many 10-year marriages like that as you can pull off, you can switch it. Okay, common questions we hear from those who are divorced. I'm divorced. My ex is going to file off of me. Is that going to affect me somehow? No, it is not. I'm divorced. My ex is going to file off of me. I'm remarried. My new spouse is going to file off of me. Are their benefits going to affect each other? No, it will not. I'm divorced and I managed to fit a few 10-year marriages into my lifetime, and I'm remarried and I'm going to die young. No, okay, just kidding. All right. Yes, it's allowed. All of these folks, all these ex-spouses can file. The new spouse can file. And yes, if you die young, they can all get widow benefits. It is allowed. Okay, I'm divorced. I'm going to file off of my ex's work history. Are they going to know that I've done that somehow? No, they will not. Okay, it doesn't affect them. They're not notified. The only way they would know is if you tell them. Okay, considerations for those who are widowed. Widows are a special group. They are the only group who can file for benefits as early as the age of 60. Now, if you were widowed prior to reaching the age of 60, you must remain unmarried until hitting 60 in order for those widow benefits to be available. So, very first workshop I did in a particular location, I don't know why. I have like this automatic thing I want to say because I've said it for almost a year and then I realized I was saying the wrong words what did I say? The very first workshop. It's not the very first workshop. It's one of the very first workshops I ever did. The first one in a library up in Port Huron, Michigan. That workshop, a gal in the back raised her hand and said in the Q&A, I think if I heard you right, it sounds like I need to delay the wedding. Room full of people. We all laughed. It was fun. But in her case, it was a big deal. So let me kind of explain what was going on. She was 59 years of age. This is a June workshop. She was slated to be married in September, but her birthday, her 60th birthday, was not until March of the following year. So if she remarried in September, she's still only 59. Her widow benefit in March, just less than $2,000 a month. Very nice widow benefit. If she remarries in September, though, she cannot file for that benefit in March. She can't file for anything in March. She has to wait 2 more years till her 62nd birthday, and then the benefit that she's entitled to is either her own or her spousal. Happened to be that the new spousal was the better of the two, just under $1,500 a month, but still, that's not a good deal, right? She's got to wait 2 years to get $500 a month less. So, yeah, unfortunately, we suggested maybe she might want to delay the wedding. Now, I'm a religious person, so I think this is funny. You can decide for yourself. She did go to, she went to her priest and said, so can we, do the religious part of the ceremony and sign stuff later? And her priest said, no, no, no. I said, there's got to be another priest. Somebody will do this for you. But she's very devout. The wedding was delayed. All right. Last bullet point. You have to be married a minimum of 9 months in order for these widow benefits to be available. This provision is not here to hurt you, though. So long as the death of your deceased spouse was not some known cause. This is here to prevent deathbed marriages. That's it. Okay? As long as they didn't have a terminal illness or some known reason why they would be passing, you can submit documentation and get widow benefits reopened. Only real life example I've run into with this, so it's not too common, but I bring it up just in case. Gal was married later in life. Husband was in the armed forces. He was shipped overseas, killed in action. They'd been married just less than 6 months. Obviously, she assumed no widow benefits. But again, it wasn't like he had a terminal illness. So, submitted the documentation. Widow benefits were reopened. John never elected for benefits. He died at the age of 64. His benefit at his full retirement age would have been $2,150. Jane, who we met, she attended one of our workshops. She was 59 years of age when John died. She's 60 when we meet her because she's trying to figure out, hey, what should I do about these widow benefits? Jane has her own benefit of $1,197 that she could file for at the age of 62. Jane has options. Most widows have multiple options for how they could file, and it's important to do planning to make sure you get the most you can that matches your situation. If Jane files widow benefits right away, she's entitled to $1,537 a month. If she lives till age 85 and sticks with that benefit the whole way, she gets $461,000. If Jane is the real Jane is still working. So for earnings test reasons, which we'll talk about in a second, she can't really file for a benefit right now. However, real Jane is planning to retire at 62, and she's done that now. $1,197 is what she started with. And Jane has a plan now to switch to her widow benefit at age 67, $2,150. So she can start with her own at 62, switch to the widow. Widow benefits maximize at full retirement age, and when she does that, she goes from $1,197 to $2,150. That's more than $77,000 more over her lifetime, not including any cost of living increases. Now, if Jane was ready to retire, she could start with the widow benefits, but it's important for Jane to remember that her own benefit, increasing to full retirement age, increasing with delayed retirement credits to age 70, is worth more than the widow. So she could collect $1,537 from 60 to 69, switch to her own maximized benefit at 70, and that is more than $100,000 more over her lifetime, simply for understanding and using her options to her best benefit. Now, I'm often struck by these numbers, 400, 500,000, okay? Not uncommon for married couples to be over $1 million, not uncommon for married couples to be over $2 million in lifetime benefits when we start thinking about the future cost of living increases. For many of us, this Social Security filing decision may be one of the single biggest financial decisions that we ever make. So there again, I'm probably preaching to the choir because you're here, but it is worth doing the planning to maximize what you get out of this system. If you would like to work and collect Social Security at the same time, it is allowed. If you are older than your full retirement age, you can work and earn any amount, and it's fine, okay? You have to pay taxes, but there's no earnings test. You don't have to worry about it at all once you've reached your full retirement age. But if you file for benefits prior to reaching your full retirement age, and you have earned income, W-2, 1099, self-employment income. You have a limit on how much earned income you can have before Social Security starts caring. Social Security does not care about the first $18,960 that you earn. Once you go above that, though, Social Security cares, and they care about $1 for every 2 that you earn above the limit. If you have an income of $58,960, here's how it works. $58,960, Social Security does not care about the first $18,960. So take that right off the top. We have $40,000 above the limit. Social Security cares about 1 for every 2, so we chop it in half. You're ineligible to receive $20,000 from Social Security if you file for benefits. Let's say the benefit that you're filing for is a $2,000 a month benefit. $2,000 goes into $20,000 10 times, meaning you will not receive a benefit check in January, February, March, April, May, June, July, August, September, October. Then you will receive a benefit check in November of $2,000 and a benefit check in December of $2,000. Some people mistakenly assume that you will receive a check all year, but it'll just be a reduced amount. No. Social Security simply will not pay you anything until you have paid back what you are ineligible to receive. Now, the right side of this almost never applies to anyone, but I'll cover it briefly. In the year that you turn your full retirement age, but before you turn your full retirement age, you can earn up to $50,520, and it is a 1 for 3 on how much they care. Okay, let's talk about taxes. Taxes, unfortunately, a little bit complicated. Unfortunately complicated. The publication 915, produced by the IRS every year, is a 33-page document that will tell you everything you could possibly want to know about how you'll pay taxes on Social Security benefits. Why 33 pages? I thought we were all going to be able to do our taxes on the back of a napkin. Oh, I don't know. Anyway, apparently I'm feeling a little bit feisty today. Sorry for that. All right. Well, it's a little complicated how taxes on Social Security works. I wouldn't mind seeing this get simplified for sure. But it's also that you all pay your fair share, right? There are some helpful things in this document, this 33-page document, like this worksheet. This worksheet will detail out for you the 19-step process that you must go through to figure out how much you'll pay on Social Security taxes. Maybe a little tongue-in-cheek on the helpful part. It was helpful to me, though. Okay, so we built an entire software tool to help us with this problem and factor it into assets and all that kind of stuff. I'll tell you more about that later. But the point is that it is a complicated process. What we are not going to do is go through all 19 steps here today. We're not going to do that. So take a deep breath. It's okay. If you're mathematically inclined, you might want to look it up and try and figure it out. That'd be fun. Maybe a bottle of wine would be good. No, don't do that. You won't make it. All right. Line 1 on this worksheet, we're going to give you some good guidance, some sort of big picture view, big picture perspective of things you should be thinking about when it comes to taxation on your Social Security benefits. Line 1 on this worksheet is where you would put your provisional income number. Provisional income is the number that is used by the IRS to follow all the rest of the 19 steps, which will determine how much tax you owe on Social Security. Provisional income is 3 things. Number 1, all of your modified adjusted gross income, all sources, okay? Earned income, 1099s, annuity income, pension income, interest income, dividend income, capital gains long and short, all of it, okay? plus non-taxable interest. So yes, even your municipal bond interest income does not get out of jail free on this. Okay, you still have to deal with the provisional income and taxes on Social Security, even with your municipal bond interest income. Item number 3 is the 50% of your Social Security benefits. So yeah, half of your Social Security benefits count towards the number that is used to determine how much tax you're going to owe on your Social Security. That doesn't seem fair. Yeah, I agree. If your provisional income number, and you are single, is more than $25,000, you start paying taxes on Social Security. If that number goes above $34,000, you could be taxed on up to 85% of your benefits. Married couples, if you go above $32,000, you start paying tax on your Social Security benefits. If that number goes above $44,000, you could be paying tax on up to 85% of your benefits. The question is, how much tax? Well, unfortunately, this is where it gets a little complicated, but let me give you an example that I think will help. Let's say that you're cruising along through retirement and everything's going well, right? You're enjoying life, you've got Social Security, you've got some pension dollars, or you're pulling a little money out of your investment accounts or your IRAs or your 401ks or whatever you have, okay? You're enjoying life, you're enjoying retirement, things are going well. But, you know, you're thinking things have been a little too cooped up over the last couple of years. You'd like to get out and do some traveling, do some sightseeing, you know, enjoy things, enjoy your retirement dollars. These are supposed to be your golden years, right? Yeah, go for it. So you talk to your loved one, you say, I've really been wanting to do this trip. I'd really been wanting to do this thing. So you budget it out. You put the budget together, you figure it out, and it's going to cost you $10,000. You go on your trip and you spend the $10,000. Maybe you put it on a credit card, but now it's time to pay for the credit card. So where are you going to pull the money from, okay, to pay for your trip? You survey all of your accounts. Well, my 401k's done well. You see the 401k over there. You say, hey, gosh, yeah, that's done pretty well. I'll pull my, my distribution, my $10,000 from there. So you call up the 401k plan. You say, hello, yes, I'd like to pull $10,000, please. They say, no problem. And then they ask you a very important question. How much tax would you like to have withheld from that distribution? Oh yeah, taxes, right, yeah. No, I knew that was coming. I knew you were gonna, okay, let's see. So maybe you sit down, you do the work, you kind of look at things, okay. Yeah, I'm in the 12% tax bracket, okay. So let's say you're in the 12%, you let them know. I'd like to withhold 12%, please. No problem, they send you your funds. You've gone on your trip, you pay off the credit card, you enjoy things, and then you get into March of next year. And then in March of next year, you're punching stuff into TurboTax or H&R Block or whatever tax software you use, or you've sent your stuff over to your accountant and you get a phone call from your accountant, or the TurboTax keeps saying you owe money. The accountant says you owe money. Wait a second, I never owe money. I always withhold enough. Something's wrong. No, I should be good. Well, unfortunately, TurboTax is not wrong. Your accountant is not wrong. You do owe tax. You made a mistake. Here's what happened. When you took that $10,000 distribution from your 401k plan, you were above these limits, and you simultaneously caused another $10,000 from Social Security to become taxable. You didn't get more money from Social Security, you just added taxes to Social Security. So you pulled out $10,000 here, you had it taxed at 12%, that was correct, except that you didn't account for the fact that Social Security was also becoming taxed at 12%, and so you really should have withheld 24% on that distribution. Now, that's annoying, it's not fun, nobody likes to owe taxes at tax season. We all like a, not a big refund, we don't like to give loans to the government, but we like a little bit, right? A little bit of refund is good. But that's not the bad one. The bad one goes something like this. You're cruising along just fine through retirement. You're enjoying life, you're enjoying your retirement, you've got your incomes coming in, but then one day you wake up and it is your 72nd birthday. Happy birthday. At 72, you pick up what is known as a required minimum distribution. And because you did a lot of prudent, judicious, smart things in your life where you paid off the credit cards, you tried to get the cars done, you maybe paid off your mortgage, you got your expenses down when you got into retirement, right? You tried to do some things to cut that down because you wanted to make sure that your investment portfolio, you worked hard for that, you put the money in, you got your employer matches, you took the money back from the IRS, all great stuff. And that account, you retire, it's a good amount, but you don't want to spend too much. You want to make sure that you have enough to care for yourself, that you get through retirement, and if you have a medical expense, you can take care of it. If you have some needs or emergencies, you can take care of it. You want to make sure that you don't become a burden to your family. So you don't spend that much. And you've retired, but that portfolio, gosh, that 401k, it continues to grow. And then at 72, you get a letter. Required minimum distribution year. Here's how much you have to take. And you look at the number and, oh my gosh, that account grew. This distribution, that's a lot of money I have to pull out. It's going to put you above these limits. And it's going to add taxes here and add taxes here from Social Security, and so much that, whoops, we're not in the 12% tax bracket anymore. 12 and 12 being 24, that'd be great. Right now it's 22 and 22 is 44. These are the kinds of tax mistakes that we believe it is vital for you to avoid. The only way to avoid this kind of stuff is with pre-planning. Make sure that as you develop your income strategies, your income plans, that you are accounting for this eventual possibility. Let's look at a case study that highlights why this is so important. Clients are 64 and 62. They have $34,000 in combined Social Security income if they both file early on at 62. They're going to start their retirement with $752,000 in 401k and IRA accounts. They will earn 6% per year on those investment accounts. They're planning to spend $70,000 a year, increasing at 3% for inflation. They'll live to 86 and 89 respectively. There are three groups of you who are hearing this example. The first group of you is saying, 752,000? Huh, what happened? Didn't they have any kids? Okay, so look, if you're looking at that and saying, gosh, that's I wish I had that much, then I need you to pay attention, because this couple with $752,000 has a running out of money problem, and we're going to show how a change in their Social Security filing strategy will help fix it. There's another group of you that's saying, yeah, okay, that's pretty close to me, not to, tweak this number, tweak that, but yeah, not too far off. Okay, so obviously this will be very meaningful to you. And then the third group of you is saying, yeah, 752,000, I knew you were going to say they were running out of money, Kyle. I mean, that was obvious. Yeah, they got to keep working. They can't retire yet. They got to keep at it. So look, if you're looking at this and saying, that's not enough, then I need you to pay attention, because this couple with only $752,000 has a tax problem, and we're going to show how a change in their Social Security filing strategy can help fix it. Okay, if this couple files Social Security benefits early, those blue lines, what you are noticing is it's covering about half of their retirement income need in those early years. The orange lines above the blue lines are the amount that they're pulling from their 401k accounts to supplement their income, and hit the red line, which is their income target increasing with inflation. The amount of the orange line above the red line is the amount that they are paying in taxes. There are some things you should be noticing correctly. Number one, Social Security does not keep up with real inflation. Yeah. Historically, Social Security lags behind real inflation by about 1%. That's because Social Security increases with the CPI-W index. You tend to spend money at the CPI-U index. Also, the amount of the orange lines, because it's ever increasing, is causing the amount of the orange line above the red line to increase not linearly, but exponentially. That's because of that double taxation process I described just a moment ago. Eventually, and unfortunately, they put so much pressure on their investments that they run out of money 14 years too soon. The only difference between this slide and the next slide is a change in the Social Security filing strategy. We're not changing anything about their investments. We're not changing anything about their tax planning. We're not implementing Roth conversions or any of that kind of stuff. Probably benefit from it, but we're not doing that, okay? The only adjustment between this slide and the next slide is a change in the Social Security filing strategy. If this couple simply uses an optimized Social Security filing strategy, which does have them delaying benefits, all of their income in those early years is coming from their 401k and IRA accounts, but look at how much more money they get from Social Security when they use that optimized plan. The blue lines, now covering a much higher percentage of their total income, technically Social Security is tax advantageous. Unless you don't do any tax planning, you have too much other taxable income, and then it's not, okay? So, I don't know if you can see it. There's a little bit of orange line above the red line, but not much. It's not uncommon when we do pre-planning for folks to get them into a position where they're paying very little and sometimes even no taxes on their Social Security benefits. Also, by optimizing Social Security, they take all that pressure off of their portfolio, and now their portfolio lasts their lifetime. If we compare the taxes, you'll notice that, yes, by filing Social Security early, they save a little bit in taxes in those early years. The blue lines are the optimized plan. So they pay more taxes in the early years by optimizing. But look at all the excess tax that is being paid, orange lines above the blue lines, simply for filing Social Security early. Now, eventually, the orange lines go away, but they're broke, so it's not a good deal. By using an optimized Social Security plan, this couple is able to get $186,000 more out of their Social Security benefits. They get their portfolio to last 14 more years, and they pay $35,000 less in taxes when they optimize Social Security, even though they weren't paying any taxes for 14 years with the non-optimized strategy. A few things about your Social Security statement. Number one, no cost of living adjustments are applied to that statement. It is a snapshot of today's benefits. It assumes you work all the way until 62, retire, file immediately, or all the way until full retirement age, retire, file immediately, or all the way until 70, retire, file immediately. Okay? What's not factored in is, let's say you work till 65, retire, take Medicare, but you delay Social Security a few years. Your statement is assuming that you're working in those years, so you just need to be aware of that. It could accidentally be misleading you. Your work history only, no spousal coordination, no widow coordination, no divorce benefits, and then obviously and certainly no advice. So look, after hearing our presentation today, you may or may not feel that you could use some advice about how best to file for your benefits. You could be feeling that, gosh, I'd like to get a more individualized look, a more specified look as to how these issues that we shared with you today are going to affect you. If you do feel that way, we are making available to you at no cost, for free, a complimentary Social Security analysis. This analysis is no cost to you, it's free, for the reason of, well, okay, let's use an analogy.
I don't know about now, actually. I don't think, yeah, I think the last time I went to Costco, okay, we're going to pick on Costco. Why do I pick on Costco? Because I hate going to Costco. Unless it's on the weekends and they have free samples. So, that's kind of nice. You like to try stuff, get the kids a snack. I have 3 kids, so, any little extra snacking can be helpful with that. So that's the only redeeming quality about going to Costco on the weekends, is that they'll have the samples. Well, why does Costco give a sample? Well, it's not because they just love giving away free food. No, they want to give you a sample so that you will see something, try something, and say, hey, I wasn't thinking about this, but that's pretty good. And then maybe you'll make a purchase. My favorite sample is the grass-fed beef bratwurst. And now it's a staple in my freezer. We always keep some on hand to throw on the grill. So that's just an example, but the point is that they give away the samples so that you can try it and say, hey, gosh, maybe this is something that I would like to have. And we sort of feel this way about this analysis. It is our opinion that our analysis is going to blow you away and wow you in such a way that we may earn the right, or, maybe I should say the honor, of serving you with other retirement planning needs that you have. Okay? So if you get this analysis from us, this free complimentary analysis, although it is no cost to you, there is cost to us in this, we do this because our experience says that when you get this analysis, you'll be very impressed by it. You will see the value that we deliver to our clients, and then we may earn, again, that right or privilege or honor of serving you in other ways with other retirement planning needs that you may have. If you're thinking that an analysis like this might be good for you, let's talk a little bit about what's in it. So first of all, personalized strategies specific to your situation. Talking to you about exactly when you should file, how should you file, what date, January of 2021. Okay, this person already filed. Maybe I should update this slide. And then, the spouse is going to switch. And, okay, it gives you that line by line, detailed analysis of exactly when it's best for you to file. It'll look at break-evens, okay? If we file one way versus another, does it work out? Does it make sense? Are we getting good time value on our money? All of this is included in the analysis. Now, the thing that will really wow you about our analysis, the thing that I think, personally, will cause you to say, oh my gosh, I'm so glad I got this analysis, is our cash flow and tax analysis portion. Our retirement income and cash flow and tax analysis is provided by a proprietary software tool that we paid, frankly, a lot of money, to construct, to do detailed level of planning and tax and income planning with our clients. The reason why we did that is because I have clients who ask me questions like, hey, if I do it this way, how does it work out? And frankly, there wasn't a software tool I could subscribe to on the market, and so I can't not answer a client's question. So don't ask me questions I don't know. I spend a lot of money to figure them out. All right, so let me explain how this software works, okay? If you get this part of the analysis, what will happen is you'll see, your incomes line by line, all the different sources and how it plays out into your taxes. This particular couple is very well advised to do a Roth conversion on an annual basis of $42,350. What that does for them is down the road when they're on their Social Security benefits, they now are not being taxed at that full 85%. And they never again, even looking very far into the future, never hit that full 85% again. So a very good deal for them. Not only are they getting more in tax-free dollars, about $700,000 of additional tax-free dollars, but they also are able to prevent taxes from really hitting their Social Security benefits in a big way. And so how is it going to look for you? We have to run the analysis and see, okay? All right. Few quick things by way of disclosure about our firm, and then we're going to talk about the Social Security filing workbook, how to get it, how to request it,
and then we're also going to start taking questions. So punch your questions in on the chat. I see a couple questions in there already. You can punch your questions in the chat, whether you're on Facebook or YouTube. I can highlight them and we'll start answering those in just a minute. Okay, but real quickly before we talk about how to get the workbook and the analysis, if you want to request that as well. But our firm, City Center Financial, that's my retirement planning firm and registered investment advisory firm. We now own and operate Einstein Retirement Workshops. At one time, we were two separate entities, not anymore. Okay, City Center Financial does own and operate the Einstein Retirement Workshops brand. It's our educational brand. Okay, when folks, if you choose to engage with us for the analysis, the firm that you are engaging with is City Center Financial. Okay, so I know sometimes people like to look us up and that sort of thing. The firm you're looking for is City Center Financial. All of our advisors are City Center Financial advisors. Einstein Retirement Workshops is our educational brand. It's how we deliver this content to you. And again, we're very honored to do that. We're excited to do it. But the firm that owns and operates that brand is City Center Financial. Okay, so that's number one. Number two, if you do get the analysis from us and you engage with us to get the analysis, we will interact with you over a video conference setting. Okay, we'll be on video, you will see us, and we will engage with you in that way. One of the reasons why we're very honored to continue to do that and offer it in this way is because it does allow us to do some cost optimization. I mean, 3 years ago, we were on a trek to drop brick and mortar all over the country and put offices everywhere. Honestly, our fees are very low. You'll find our fees to be about half of the national average. And the reason for that, in part, is because our costs are low. Okay, we do things that we can optimize by being more centralized, working with people in that video conference setting. No matter where you are in the country, we're able to work with you. And by having that level of efficiency, we are able to keep our costs far lower than the national average, despite offering, if I may say this, a better than average service. Okay, so last thing, any advisor that you work with to get your analysis, NSSA certified, National Social Security certified. Okay, as you proceed in that process, if you have higher level of needs, we will have you working with a chartered retirement planning counselor, an accredited portfolio management advisor, someone with a higher level of certifications, education, experience, and credentials to assist in those next steps of retirement planning or retirement investing. Okay, those steps in the process would be things that we would do where you say, I've seen the value of the free analysis and I'd like to learn more. I'd like to see how more you can assist me and benefit me with my retirement planning needs. If we get to that discussion, we will obviously disclose all fees and costs to you. We're honored to do that. Again, our fees are, the national average is 1.65% on advisory fees. So we're less than half of that. So we're very proud of our investment advisory fees. And so we're honored to discuss those with you. Okay, but all of that would be disclosed ahead of time before you would ever pay us. Okay, so I think I've made that all really clear, but if you have questions about it, please let me know. All right, sendworkbook.com. Again, put your questions in the chat. I'll start answering them in just a minute, but at any time, go to sendworkbook.com. At sendworkbook.com, you can request your workbook. We want to make sure we get that to you, so open a new browser tab. If you're watching this on the computer, maybe go on your phone or vice versa. Just go ahead and get that submitted. So we want to make sure that we get you a copy of your workbook. And then also when you're going through that process, if that analysis is something that you feel you could benefit from, simply say, yes, I'd like my analysis, and you can go ahead and request that. And again, I'll still be here answering questions. So do it however you like. Okay, with that, I'm going to start answering these questions. Okay. Oops. Almost knocked off my microphone there. All right, Cynthia Howard says, I'm 62 in February. When should I file? Well, it depends really a lot on your specific situation, Cynthia. So, are you going to retire by then? Are you going to be, do you have other forms of retirement income that you could rely on for a little while? These are all questions that we would need to answer. Okay, Buster says, I'll be 80 in December. Am I too old to make a Roth worthwhile? Thanks, great presentation. Thank you, Buster. No, not necessarily. I would say it's never too late, although you probably have missed some optimization opportunities, but no, it's probably never too late. Buster also asks, are you licensed in Louisiana? Yes, sir. Yes, we are. Okay, Gazala, I hope I'm saying that right. If my spouse has never worked now, he is getting his Social Security income through my earnings. Okay, yep, that's right. If he makes a big chunk of money with a business deal, how would he be affected with his Social Security benefits? It depends on if he is younger than full retirement age. If he's younger than full retirement age, then it depends on how the income is classified. If he's older than full retirement age, don't worry about it. If he's younger than full retirement age, it depends on how that income is classified. Is it going to be classified as a capital gain? If it is, that's not a problem. The only income that's a problem is earned income, 1099, or W-2. W-2 or self-employment. Thank you. That's the other one. Okay. Good questions. Again, at any time, you can go to sendworkbook.com, request your workbook, get that form filled out. We do want to make sure we mail it to you. Also, if you found the presentation to be helpful and you liked it, subscribe to our YouTube channel, follow us on Facebook. We'd love to interact with you at future events. We have a podcast that I used to say is our daily podcast. It's called the Einstein Retirement Daily. It's not quite daily as much as I wish it was. But little time constraints there. But we do try to do that very consistently, and we think you'll get good value from that. We also have other workshops and topics that we do from time to time, and we'd love to see you at those as well. Okay, more questions coming in. Rick says, I have the higher income and plan to delay filing Social Security until 70. My wife is 65 and will file for Social Security at her full retirement age. Can she switch to the spousal benefit once I file? Yes, if the spousal's higher than hers, the answer is yes, Rick. Ella says, I am still working and I am at full retirement age. Should I assume you mean like should I file, or when will it be the best time to file? Okay, well, again, it depends on the specifics around your situation, Ella. So, do you have other sources of potential income that could be affecting you either from a tax perspective or, maybe giving you an opportunity to offset your income needs so that you could do a delay and get the 8% guaranteed increases? There's just a lot of questions I would have to ask to really be able to answer that one for you. Okay, Trish says, I'm going to be 62 with no retirement plan. Well, don't do that. Let's get you a retirement plan. All right. I work as a CNA in a nursing home with 32 years of experience. My husband is on SSDI at age 58. How can I retire on such low income? Oh, maybe you meant by no retirement plan, you mean like no retirement savings? If that's what you meant, then yeah, you have a challenge, right? Is there some opportunities? I mean, the best thing that you could do would be to try to find some way to get some dollars put away, obviously. Otherwise, I'm not exactly, how can you retire? I mean, it's going to be tough, right? It's going to be very tough. But probably you're going to want to try and work till 70 to maximize your Social Security. And if you can get any dollars put away at all, it's going to make a big difference to you, Trish. Oh, good. Thank you, Gazala. Mitchell says, my wife is already receiving her Social Security on the disability benefit. Okay, I'm 64 and just retired. Should I wait or file? Okay, Mitchell, and everyone else is going to ask me if I should file. I'm a such and such age. Should I file? I gotta know more. Like, how much do you have in savings? What's your tax situation? If you delay, can you optimize your taxes so you don't have taxes in the future, or does it not make any difference? There's so many factors that go into this. Are you still working? All of that. So you just got to understand that the question about when should I file, I wish it was simple, but you got to consider all the variables. Big ones are taxes, longevity, opportunity for optimization with your portfolio, not just taxes today, but taxes down the road. These are all the questions we need to know more about. Okay, Lydia says, hi, I turn up next week. How can I find out what my deceased husband's benefits are? If you mean like you have an appointment next week, great. Okay, so you'll probably want to make an appointment with Social Security to get that information, unless you can find an old statement somewhere. That's another possibility. If you can find an old statement, we can probably help you figure it out from there. If not, just make it an appointment with Social Security. Jill says, I am divorced. How do I find out how much my ex's benefit is? Could I file for his at 64 and file for mine at 70? Jill, no, you're too young. You can't do that, okay? So an appointment with Social Security is going to be the best way to get you the answer about what your ex-spousal benefit entitlement would be. I'm guessing, just based on that little bit of info you gave me, that probably you're only going to file for your own. There won't be anything available from the ex-spousal benefit. Okay, but I could be wrong. Depends on what your earnings have been like. Oh, 60 next week. Okay. Lydia says, I turn 60 next week. Yes, an appointment with Social Security, Lydia. That's what you need. Buster says, wife gets more Social Security than I. If she dies, will I get hers? Yes, Buster. Yep, yours will go away. You'll keep hers. Kirk says, should I wait until after I receive the filing workbook to speak with you? Kirk, the workbook is really a do-it-yourself kind of workbook. So if you're going to speak to us and get the analysis, the workbook's a good reference tool. It's nice to have. But the analysis will answer all those questions. So I wouldn't necessarily wait. But good question. Gilwith says, I heard there was a deadline that I have to set up a Social Security account by. No, that's not true. No deadline. Regardless of whether I'm going to be receiving payments. Is this true? No, it's not true. So generally, you do have to file for Medicare at 65. But if you're covered by an employer plan, that's also not true. So the answer is just no. None of that is correct. Trish, no retirement savings. Okay, I got it. Okay, Trish is not feeling good about doing any delaying. Well, Trish, you gotta sort it out, right? So. Maybe working and filing Social Security, putting that money aside to help with future, the possibility that you live to 70. There's always a chance, right? So just, bear that out. Okay, Carolyn Martin says, I'm 63. When I turn 65 and get Medicare without collecting Social Security yet, how much does my Medicare cost plus my supplement insurance? I know when I get my Social Security, it will come out of that. So, Carolyn, when you filing for Social Security and Medicare costs are divorced from each other. Yes, you can have Medicare Part B withheld from Social Security, but they're not tied together in some way. Okay, so the only caveat to that has to do with the COLAs, and we're not going to worry about that at the moment. But the thing I would say is your Medicare premiums, how much are your Medicare going to be? It depends on what kind of supplemental policy you get, A,
and B, it depends on your income. So there's a provision called the Income Related Monthly Adjustment Amount, IRMA. That IRMA means that if your income is high enough, it will increase your Medicare Part B premiums. Okay, so you can Google IRMAA, Medicare Part B, and it should be the first thing that pops up is medicare.gov, and it will show you a table of how that works. Okay, life hack, Hackabee. Anyway, okay. Nice handle on YouTube. All right. My husband is 60 and wants to delay Social Security until 67, full retirement age. If I understand, as a 57-year-old, I can file early at 62 and get a bump up to the spousal, assuming it is higher. Yep, you understood perfectly. Yes. Robert says, are 1099 earners penalized as it relates to Social Security benefits? I've heard that Social Security Administration screws up a lot with making sure the income shows up on my statement. Yeah, you should check every year and make sure it's correct. Yeah. I don't know if they're not penalized. They're not penalized, but you do have to check your earnings history and make sure that it's correct. And you got to check every year because there's a statute of limitations on getting it fixed. So important thing to stay on top of, Robert. Okay, Patty says, I was late. I'm a widow and saw that I will be eligible for not spousal benefits, widow benefits. Okay, widow benefits is a specific provision at 60. If I'm making okay money, should I still file for the widow benefit? Well, you have to deal with the earnings test. Anytime you file for anything younger than full retirement age, you got to deal with the earnings test. So it depends on your specifics, Patty. Sometimes even if you have the earnings test, it's still worth filing. So you just have to look at all the details and decipher what's going to make sense for you. Oh, okay, great, Mary. Good. Mike and Mary. All right, good. We'll be happy to help. Okay, Susan says, should I get the analysis now even though we are 63 and 64 and a half and married and have an IRA and metals in a vault? He's just going to apply to Medicare, not retiring yet. I stopped working a few years ago, have been applying for SSDI, I've been denied, so should I get the analysis? I can't tell for sure based on that, but you know, if you do get the analysis, we'll be able to tell you if it was helpful. That's silly. Yeah, I mean, it's hard to say for sure. I give it a 60% chance that it'll be helpful to you based on what you gave me. Maybe that's too low. Okay, it might be. There's a good chance it might be very helpful to you, especially for your husband's timing and then potential tax situation. That's where it's going to help you the most. Okay. All right, Nini says, I can't download my Social Security statement. My computer won't let me. You need it for my analysis. Now what can I do? So Nini, what you want to do is you want to make an appointment with the Social Security Administration, and they can get you a copy. Otherwise, maybe ask a friend or a loved one if they can help you with it. Okay, that would be the other option. If you can get into Social Security, maybe somebody can help you with it. All right, Ms. B says, I was working and retired in June of this year. However, I was told that I must file within 8 months for Part B. That's Medicare. Yeah, Medicare Part B, where there's a penalty. Yes, that's correct. That's correct, Ms. B. So, yes, make sure that you take care of Medicare Part B within, it's actually 6 months, not 8 months. No, not 8 months, 6 months. And if you're getting the analysis, make sure you ask about it if we can help you with it if you need it. Okay, but there's tons of Medicare people, so no problem. You're welcome, Susan. Okay, Maria, is military retirement pay part of this income Social Security will consider? not for the earnings test, but yes for taxes. Okay. All right, we're going to wrap up. Thanks everyone for your attendance. If you haven't already, go to sendworkbook.com, request your free workbook. We're happy to send that to you. If you think the analysis is something that could benefit to you, we'd love the opportunity to interact with you, put our best foot forward, and see if there's some things that we can help with in your retirement planning needs beyond. So with that, I wish everyone a good night, and we look forward to seeing you next time.